There are two market maker models, market maker buy model and market maker sell model. Now in this specific lesson I'm going to give you guys the initial consolidation part of the market maker buy or sell model. Either way, how the initial consolidation starts, where you can identify or how we can identify those, how to mark those, and how you can utilize that information. That is the initial consolidation part. Now for every market maker model, which this is the market maker buy model, this is the market maker sell model, there are two sides of the model. For the market maker buy model, you will get the sell side delivery of a market maker buy model, and after the sell side occurs, you will get a buy side delivery that will target the initial consolidation's liquidity. Along with that, if there is any higher time frame point of interest or a nearby liquidity level that is sitting around that area, market will go check that liquidity as well, or go to that higher time frame point of interest. Same thing with the market maker sell model, which is consolidation, then the first move or buy side curve of the market maker sell model, the other side will have the sell side of the curve. Okay, so in this term you have to look into your higher time frame. If your higher time frame is bullish, you will look for a market maker buy model. If your higher time frame is bearish, you will look for a market maker sell model. Now at the same time, if your higher time frame is bullish, the market buy side of the curve of a market maker buy model, this side will be the highest probability or high probability trades will be sitting right here. But the using the information, or if you practice enough, you can participate the sell side of the curve as well. So those are the main things that I wanted to talk regarding the market maker model, market maker buy and market maker sell. Those are the models. However, I will be focusing on this specific part of the video, market maker sell model, and the initial consolidation is the main part of the video. Okay, so without any further ado, let's go to the initial consolidation lesson. Okay, so let's zoom into the initial consolidation of a market maker sell model. So here is how a consolidation looks like. Now this specific drawing is a very clear drawing that you are seeing equal lows or equal highs on the drawing of the swing points. However, it's just for the sake of the example or to understand the basics. Things might not look this picture perfect every time. Sometimes you have to identify this. That is the practice actually. You have to look for the areas. There might be sometimes equal bodies or equal highs. Smart money or the institutes, they try to first create some buy side liquidity in the forms of buy stops and some sell side liquidity in the form of sell stops. So where should you look for this stuff? Usually a consolidation will happen after a run of liquidity. Here are some notes that I'm actually giving you. Note is higher time frame bias is the key. If the higher time frame bias is bearish, you are looking for a market maker sell model. If the higher time frame bias is bullish, you are looking for a market maker buy model. As I said earlier, look for small candles after a run on liquidity. So market will take some liquidity from the previous area or previous level. After that, it will start to consolidate. So how does that work? Based on the first video is, think this way, that market has expanded lower, taken some liquidity. Again, it was doing the consolidation or the accumulation phase. After that, you are expecting a manipulation, then a distribution. So this is aligning together with the first lesson as well. If you have missed the first lesson, go and watch it carefully. Take notes, watch the full video. It's funny how people are willing to learn things that I have mastered for 3-4 years of trading, and they don't have even time to watch a 7 minutes worth of video. That's the consolidation. Now what we look for after a consolidation, we can look for a variation that can probably happen inside of the consolidation. Now if you find any higher time frame point of interest near your sell stops, let's say there is a higher time frame PD array, that can be fair value, order block, breaker block, inversion fair value, whatever you have mastered. If you find something like that sitting right below the sell stop, the setup for the market maker model becomes very high probability from that area. Now usually what we are willing to see from this specific move is market from there coming on top of that higher time frame PD array and then giving you the first move, which is the buy side curve of a market maker sell model. We are looking for something like this, but there is a variation, or here is a variation that you can look into, and this is more obvious or more powerful than the regular accumulation, manipulation, distribution, because market will not be this clean all the time. What market will do, or smart money will do, is first it will take some liquidity from the buy stops. So market will first give you a move towards the upside so that the breakout traders, they can anticipate the long positions. Market will manipulate lower for the sell stops, because most of their sell stops will be sitting below the sell side of the initial consolidation lows, because they look into this area as a support resistance area. However, what smart money usually does is, when these people entered into a long position, they will try to buy their sell stops. Remember, if you are willing to take a buy, if you are trying to buy from the market, there must have to be a seller who is willing to sell to you at a certain level, right? So buy sell works that way. You cannot buy if there is no seller. Same way, you cannot sell if there is no buyer. So first they are introducing some buyers over here, and their sell stop or stop loss is sitting right here. So how we anticipate our stop loss? We put it as a sell stop order. So smart money will take that stop loss or the sell stop orders as their buying opportunity. This is where they will buy, and this area you will get some high probability if there are higher time frame PD array or point of interest you have sitting right below the sell stops. So smart money will pair their order with the sell stops, the buy orders. Market will go higher. It will give you the buy side curve of the market maker sell model, and later on smart money will utilize that area to exit out of their position when they are actually giving you the original move or the distribution leg, so that from the high or from the top, from wherever the market is willing to come lower, okay, so they will pair this area where with their exit out positions. So first they will take the buy long or the buy side of the curve, they will make the money. When market is at the point of interest, what market is always doing, it is either seeking liquidity or balancing imbalance. Now if there is a higher time frame point of interest as a imbalance sitting above some buy side liquidity at those higher levels, that will become a very high probability. But since this is just the consolidation, keep in mind that I'm just teaching you the consolidation, the buy side of the curve and the sell side of the curve. It will be explained in a detailed form. Also there are a lot more goes with this. So this is a variation of the market maker sell model that you will sometimes see, that market has taken the buy side, it will go lower, take the sell side with a higher time frame PD array, it will pair their orders, and then it will eventually give the move towards the buy side as the buy side curve of the market maker sell model. Okay, so this is one form of variation on the market maker sell model, and the similar thing you can look into as a market maker buy model. So in this case you will find something like this. So market will first give a fake move towards the sell side, as a breakout structure or breakout trader. They will think, okay, market finally broke the structure, so it's going lower. Market will get those positions in. When they're putting their stop loss or buy stops above those consolidation or initial consolidation range, smart money will push the price higher to pair their, or the algorithm will push the price higher to pair the buy stops with the smart money sell orders from a higher time frame PDRA. Market will go lower, and this is the starting of a sell side curve of the market maker buy model. After reaching to the point of interest or the terminus that we can call, market will again deliver for the buy side of the market maker buy model. Yeah, so on a market maker sell model, you can look for equal lows as the engineered sell side liquidity to run on run later on, or you can look for equal bodies as your target or as your sell side liquidity to run later on. Both of them has a high density or high amount of liquidity sitting right below those levels. On the market maker buy model, you will be looking at something like this, either a equal high that will be left behind to run later on, or equal bodies that will be sitting right there to run later on, something like that. Okay, so I hope the initial consolidation part is clear. There are a lot of things that still needs to be cleared, but I hope by the end of the series things will be clear to you guys. So just for the sake of the learning purpose, focus on the chart. For these two lessons, whatever I have provided, you will be understanding step by step, and whatever you are learning throughout the videos, before the next video comes, whatever you have learned, try to identify those and try to look for those things. So look for the buy side curve of the market maker sell model, and later on the sell side curve of that, if you can understand from the first drawing. If not, still okay, just try to figure out the initial consolidation and look what price does around those areas, if you can identify those. So yeah, I hope that was insightful. Until next time, take a very good care of yourself, your health and your loved one. Bye bye.